Joining us next is Abe Karar, Chief Product and Innovation Officer at FinTech Galaxy. He will be talking to us about deploying a national open finance infrastructure, accelerating the path to open economy.
Thank you so
Abe.
much, Prasad. And good morning, everybody. It's a pleasure to be here. This is actually round two with this presentation. Unfortunately, yesterday I was in Iraq and connectivity wasn't great. When the power went out, so did the internet connection. So I'm back to try to give this a second shot. So let's see how it goes. First of all, I wanted to take a moment to introduce myself and our organization, just to give a bit of background. Myself, I'm a banker of 18, well, I guess 15 years, and the remaining was mostly in digital transformation. My background is in data and analytics. Worked for large organizations such as JP Morgan Chase, Bank of America, and Bank of Montreal, and then most recently in the region, been focused mostly on open banking and open finance. And FinTech Galaxy started the journey about 4 years ago, and we look at the end-to-end journey, starting from open innovation and then going through connectivity, which is either from a compliance perspective to comply with regulatory requirements for open banking, open finance, and then obviously on the aggregation side. And I'm sharing this background because it's important to understand the perspective that I'm about to share with you, because it is based on some industry expertise. It's based on a lot of discussions we've had with governmental entities, central banks, regulators, and of course, based on learnings from other markets. We focus primarily on the platform side, but with all of the encompassing modules around it to ensure that when a technology is provided to one of our clients, they're actually able to deliver value with it. So that value creation is very much built into our DNA. We've been working with a lot of the large institutions, as you see here, and we've built out a fintech ecosystem with over 1,000 fintechs. About half of them are from the region, and globally from across 70 countries. And again, innovation is in the DNA. So it's important to know that technology is only about 20 or 25% of the win, but it's really about what you do with it. And what we do with it is we try to build on the innovation, and we build out proof of concepts and such. So what I wanted to cover with you today is the concept about deploying open finance as a national infrastructure, an open finance national infrastructure. What you see on the screen here is there have been 3 models that have been followed around the world. And let me just give you the scenario just so you understand what I'm talking about. Let's take a live example. Bahrain. Bahrain at the moment is the only country that is regulated in the Middle East. Bahrain started the journey late 2018. At the time, actually, I was living in Bahrain, and I was working on digital banking with Arab Financial Services. And I remember the central bank came to visit, and they were talking to us about how they're mandating the banks to prepare their infrastructure. And they had came out with the first draft of the regulation, and they said, we're going to do this in phases. And there was the initial draft, which was, interestingly enough, the UK standard. And by the way, this is a very interesting observation, and I shared this on a panel yesterday. A lot of the countries, what they have done, including Bahrain, is they will start with an existing regulatory framework that has worked, and then they will deploy it in their country. But then they will customize it, which is exactly what happened in Bahrain. Although when you look at the specs, they're almost the same, but they still came up with their own, let's call it localized version, especially when it comes to the other aspects of the regulation around operational guidelines and SLAs. How long do you capture the consent and keep it on file for? When does it expire? And by the way, this is the right approach, in my opinion. You cannot just lift and shift a framework and decide that it's going to work. I know that Saudi has also started with the UK standard. Some of the clients that we're working with, we are definitely recommending an open finance approach, which in that case, you're better off looking at the CDR standard and such. But just bringing it back to how they did it, they broke it out in phases, and they said, phase 1 of the BOBF, the Bahrain Open Banking Framework, will include these use cases, which are the type of APIs and the functions that they can perform. And this is the deadline. And then phase 2 will be these. And then, of course, since it's regulated, and this is one of the things I also believe work when it comes to implementing open finance or open banking in a specific jurisdiction is enforceability. So there were penalties levied, and of course there were extensions and time was given, but it wasn't just loose. And when you look at the way they did it, they gave the banks an opportunity to become part of a working group, work with some of the industry players, some open finance companies or open banking companies, and provide their feedback. And it was a collaborative approach. But when it came time to implementation, it was either an in-house implementation or a third-party vendor implementation. And just let me take a moment to explain that. The in-house implementation is when the organization says, you know what, guys, I have a large IT team, they have the capabilities, and they will take our existing, API gateway, they will connect the API endpoints to the core banking or to the middleware, and they will ensure that these APIs are exposed publicly, but then they will add all of the other relevant components that are required for open banking. Such components are the consent management. How are you going to manage that? How do you store the consent? How do you send it back? How do you revoke it? The customer authentication, a strong customer authentication. Also the reporting and monitoring that has to be delivered to the regulator to ensure compliance, the SLA management, and of course, the developer portal that allows the TPPs, the third-party providers, to connect, test in the sandbox component of the developer portal, but then also promote their app to production. And then, obviously, all of the certificate management and the security standards and such. So some organizations, HSBC, ING, Deutsche Bank, they have that capability, so they built it in-house. Interestingly enough, also when you look at some of the banks in Saudi that are going through this journey, they are going through this as we speak. And it's fascinating when you visit the banks and you do a bit of a tour. Some banks have actually said, we've built it in-house. We went out, we bought like a gateway. Some deployed Kong, some deployed Apidays, some deployed like an IBM Connect. Regardless, they've built then all of the components around it. And yes, some of these technologies come with out-of-the-box capabilities that allow you to comply. Okay. Then there are some that said, you know what, this is just a lot of work, and not to mention that there's also the operational side of it. It's not just the technology. And those will go out and they will approach a vendor, and they will get the vendor to provide them the infrastructure, and in some cases, even provide them with the operational support. So when a TPP comes and they say, hey, I want to connect with you, it is not managed internally by the financial institution. They just send them to the vendor, and the vendor deals with them based on the requirements and the regulations. And in the case of Bahrain, that was mostly at the time there was an emerging partner in the ecosystem, and they were able to capitalize on the opportunity, and they connected most of the banks. Now, the third option, which is interesting, is the consortium option. And this type of consortium is what allowed you to deploy a countrywide or a national-wide infrastructure. And there have been some interesting success stories. If you look at the screen, you look at CBI, which is in Italy, connected over 500 banks through this one layer, a national layer. Redsys in Spain, over 40 banks, and LuxHub. And funny enough, last event, which was the Open Banking Expo in London, I met one of the guys from LuxHub, and he was telling me about how the banks came together. They created this entity, and then they started working together, which is a fantastic example of collaboration to build out, this uniform layer with all of the API documentation, all of the API catalog, the API management, the reporting, and such. Now, the idea of a consortium typically has to be mandated by a higher power, if you will. If you look at our region, you'll notice that most of the payment companies or the payment schemes, not all of them, but they are purchased and owned by the banks. If you take a look at Bahrain, Benefit, which is the payment company, but also does the credit bureau and does KYC and manages, other things, let's just say that, they are owned by the banks. Let's take Jordan. Jordan, they have an entity called JOPAC, and JOPAC is also owned by the central bank and the banks. When you look at Libya, there is an entity called Muamalat, again, owned by the banks, and they specialize in payments. Saudi Pay, and so forth. The examples go on. What that makes you think is, okay, if I'm a country that's about to embark on this journey and I want to accelerate the adoption and I want to remove some of the challenges, and I will share with you in a second what were some of these challenges that were faced in some of the other markets that took one of the first two approaches, then I should leverage what I already have. So it doesn't mean that you have to go out and create a new consortium out of nowhere, especially if you already have something like that, then you could build on top of it, and that becomes a way for you to create that synergy. Now, interesting question that just, asks itself, but how do you create competition? How do you create differentiation? Like if we're all going to be on the same layer and we're all going to be connecting our data and all through the same thing, like I want to be my own, bank, and I want to be competitive with the other financial institutions in the market. Well, my answer to that is when you go out and you buy Oracle, an Oracle database, or an Oracle FlexCube core banking system, or you go and you buy a Microsoft Office suite or Microsoft SQL database, or you go out and you buy Amazon, whatever, isn't the same product being sold to bank A, bank B, and bank C? It's what they do with it that makes a difference. So the very simple approach of saying, you know what, guys, just let's for once put the differences aside and understand how do we take advantage of the fact that we can create value for the ecosystem and level the playing field. And then what you build on top of that technology is what really allows you to differentiate yourself as a bank. Another interesting thing about this consortium approach is you have a lot better traction when it comes to pushing out updates and getting everybody to adopt. So let me give you an example. And that example is going to tie to the point I wanted to make about some of the challenges. When Bahrain, and I'm using them as an example because they're the ones who have been leading in the market so far, when Bahrain said phase one and they focus on some account information APIs, accounts and transactions and listed beneficiaries and such, and then some payment APIs. And then in phase two, they added more payment APIs, standing order, international, cross-border, and such. You found that even the speed of adoption wasn't the same because some banks may have not worked on their payment APIs. So as a result, they may have been able to hit the first milestone and then they got quite delayed on the second milestone. And in other cases, now the central bank is debating, okay, we want to move forward into open finance, but then our fear is we come across some of the same challenges where the banks are not seeing real value even from the first implementation. And by the way, this is a very common problem, and that typically comes from not taking the time upfront to think about the business outcome you're looking to achieve. And when it comes to the consortium model, the national model, you could take the time with a working group to establish certain requirements upfront that will deliver business value. Let me break this down for you. We always say open banking, open finance, it's going to help us with financial inclusion. Okay, great. Then you ask somebody, what do you mean by financial inclusion? Well, I want to get more people banked. Look at Iraq. Look at Egypt. Oh, look at UAE. Look at Saudi. Okay. Well, you realize that open banking, by definition, is only adapted to payment accounts, CASA, current and saving account, which means that unless you have an account, you cannot benefit from open banking. So then you get the philosophical response, okay, fine, then maybe I'm talking about better accessibility to finance. I'm trying to help not the unbanked, but the underbanked. So I'm going to take SMEs that cannot get a credit history, don't have credit history, or they don't have enough information to show how much they are worthy of credit, and we're going to use their transaction history to show, the inflow, the outflow, and how much they have saved at the end of the month, and blah blah blah, and how much they paid their suppliers. Okay, great, but it still doesn't answer the fundamental question of, is it really solving financial inclusion? So now let me ask you this: what if, just what if, in this consortium model, right from the beginning, this group, let's take, let's take Egypt, for example, and we decide that we say, Central Bank of Egypt said, I'm going to push out a regulation, a framework, but guess what, guys? I'm not going to do payments. In my phase one, I'm only going to do data APIs, but my data APIs are going to be for accounts and wallets. Oh, wait a second, a wallet? Well, yeah, a wallet has a balance and it has transactions, and you can add beneficiaries, and it almost mimics the same model of a current account, a light current account, if you will. Well, then now we're talking. Now we're actually building an infrastructure that will cater to more of the unbanked population and can help. When I was visiting Iraq and I was talking to the banks, I realized that 70% of the population use wallets. 70%. People actually, I was shocked because when I go out for dinner and I wanted to pay by card, they're like, sorry, sir, we don't have cards, you gotta pay cash. And I'm like, well, sorry guys, I only have dirhams. So it was my first experience where in Iraq, they accepted UAE dirhams, otherwise I would have walked out without paying. But the point here is, guys, you have to think about the business value up front. And when you're doing it as a consortium, you ensure that everybody is on the same page. Because listen to this, if you decide you're going to push out this business model, but then you have 10 e-wallet operators and 25 banks, and you don't get them all on the same wavelength, then you end up having a problem. Let me give you an example of that problem. Let's take a very simple use case. Account aggregation. It's aggregating balances. And to aggregate balances, you would typically need access to multiple banks, and these multiple banks will provide the data that then gets aggregated. So let me take one TPP. This first one here, one of my favorite, companies out there, very nice startup called Genify. They do PFM, and they now, let's say, worked with one company and they launched an app. And in order for them to bring in all of my balances in one place, and Abe banks with these two banks, Mashreq and Emirates MBD, and he also has a wallet with Itisalat. Okay, unless Itisalat is connected, and unless the other banks are connected, then Genify will not have the right coverage. And by the way, the model that I'm referring to is this model, where all the banks and all the fintechs are connected to one layer. This model, what you see here, is the traditional model, where you've got Bank A with their own infrastructure, Bank B with their own infrastructure, Bank C with their own infrastructure. This infrastructure was built in-house. This one was purchased from a third-party vendor. This one was purchased from a third-party vendor from outside the country, and they decided to localize their solution. So you end up with inconsistencies. And now what also happens is this TPP, Genify, needs to connect here, needs to connect here, needs to connect here, needs to connect here. And you're going to say, but Abe, it's open banking. The specs should be the same. Yeah, I know. And guess what? The banks still have inconsistencies. And we're not talking in our markets. Go look at the UK. For the longest time, Barclays, I was talking to Nordigen, and they were telling me that Barclays didn't publish an IBAN. But then they went back and they fixed it for the longest time. So what you end up having is multiple integration points. These poor guys have to do all this work. And the banks, when they end up having to do reporting to the regulator, which is mandatory, each bank is uploading data. And some of them are doing push, some of them are doing pull, most of them are doing push, some of them are sending Excel files. But when you end up with the implementation like this, and this is a consortium model, or let's call it a national model, this is where you end up with one layer. That layer has the one gateway that's exposed to the market. And here you have all of the TPPs. These TPPs could be financial, could be fintechs, they could be non-fintechs, they could be e-commerce platforms, they could be schools, they could be small businesses, they could be corporates, right? And down here, you have regulators, and the regulators don't just have to be central banks. They could be a central bank. They could be the equivalent of a CMA, the Capital Markets Authority. They could be equivalent of the Insurance Authority. And why would they be connected? Because they want regulatory reporting. They want to look at the SLAs. They want to see how the financial institutions are providing the data. They want to look at the volumes. Volumes show adoption. Very interesting metric I shared the other day. Look over 1 year in the UK. This was the impact report. Look it up, OBIE impact report, October of last year, that when it was published. And they show you that between August 2020 to August 2021, number of payments through open banking went from 700,000 to 11 million. From 700,000 to 11 million. If that is not a sign of adoption, I don't know what is. But look, guys, Reporting is what the regulators need, and what allows you to understand the market. When I used to teach at the university, I teach performance management because background is data analytics. I used to say, guys, listen, whatever you can't measure, you can't move. Done. End of story. So measurement allows you to monitor the market. Now, another observation down here, these are not just banks. They're banks, they're insurance companies, they're pension companies, they're wallet providers, they're microfinance companies, et cetera, et cetera, et cetera. So obviously you could tell that I'm an advocate of this national approach, but you have to realize that it doesn't work everywhere, right? Let's take a very obvious example where there is one regulation and it's across in one massive region, Europe, PSD2. When you look at the banks, even when you look at aggregators in those countries, TrueLayer, Salt Edge, Think, Token, whomever else, they have all acquired a large number of connections. They have large coverage, but the amount of time spent on maintaining and normalizing the data and following up to ensure takes up a lot of the effort. And this is why in those markets, the aggregators play an important role. Because an aggregator allows you to move away from this to this. Well, hold on a second. That means, Abe, that what you just showed us here is already an aggregator. Et voila, you're absolutely right. So think about that. By taking this approach, not only have you ensured compliance at a national level, you have also inadvertently or purposefully created an aggregation layer, because you've already aggregated the APIs from all the financial institutions and you've made it easier for the TPPs. Now, let me now tell you about where the banks can create value. The banks can create value by starting to offer premium APIs. So the data that comes out, transaction data or balances or whatever, that becomes very simple data. And I was pitching yesterday to one of the banks. I'm like, guys, let me just ask you something. What if you guys are a digital bank? You're less than whatever. You're 8 years old. What if you come up with a smart banking for SMEs? And SMEs is now a very important segment in many of the markets. And you realize that if you were to leverage a model like this, but then provide the ability to integrate bring the data and then and pass it through to an accounting software that could be partnered with the bank and part of the package, you be able to give them the ability to access all of their balances in one screen. So a very basic treasury management capability. You're able to allow them using and remember, and I'm going to talk about this in a second, when you start looking at open finance, it's no longer AIS and PIS. It's no longer account information services and payment initiation services. It's actually data, payments, and actions. So let's talk about action APIs. Imagine you are able to issue virtual cards on the fly using action APIs. And this can be done again through this model. That allows you to create a special package that is for SMEs. And trust me when I say this, because I used to have my own company in Canada. I would pay for that, a premium, because the amount of time I used to spend on just doing my accounting or doing my books was just astronomical. And I wish I had, when I had employees, I can give them virtual cards or their independent cards with their own balances, so I can streamline the expense management. I wish that when I ran my business across different countries and I had different accounts, that I could always bring it all in one place. So this is just an example of where the financial institutions can create value, because they are also part of that aggregator layer. They no longer have to go and do single integrations. From a regulatory standpoint, one of the other benefits that we have to be mindful of is when the central bank or when the consortium is looking to bring new capabilities to the market, new APIs to the market. They could actually do that quite easily in the Sandbox environment by publishing the new endpoints that are connected to some sort of demo mock bank that simulates the bank. And they could leave it out for 6 weeks, 8 weeks, and they get feedback from the market. Because look at the components here, by the way. These are the standard components of an open finance platform. You've got a developer portal, a portal in which there is the test and production accessibility, managing your connections, managing the consents, all of that jazz. An API catalog, all the documentation of which APIs you can access, the API management, managing the all the way down to the data lineage of the API and who has access to what. And because these TPPs, by the way, depending on their license and depending on the consent and what have you, that will be managed differently. The sandbox environment is what I'm referring to right now. Here, you can say, oh, well, guys, next quarter, we're going to start to do we're going to start working on loans and mortgages. Let's start with a simple PLOC, a personal line of credit. We're going to start with a very simple one, which is an unsecured, so we don't have to worry about collateral or any of that. And here's the data model. Somebody who is managing the platform will then publish the documentation in sandbox mode, meaning you read the documentation, obviously, that then the actual endpoints for you to consume, whether through an app or through, an API client like Postman or whatever, can be done in the sandbox. And once all the feedback has been obtained and the APIs have been refined, then you can easily promote them to production APIs. But then the banks obviously are expected to expose there's usually these lines means that there is a small connector that sits. Oh yeah, and one other thing, but let me just finish this thought. And through the monitoring analytics, which is both for sandbox and from production, the regulator gets a sense for what works and what doesn't. And of course, as I already mentioned earlier, the consent management, etc. Now, the core banking connector, or what you can refer to a connector API, actually sits at the financial institution. And what's important to note is this, let's call it deployment. If you're doing it at a national level, you have one of two approaches, which I guess is common sense. You could approach it on a cloud, which in most countries, it will be a private cloud, and that's totally fine. A lot of the consortiums that already have payment capabilities and are a bit more mature, they have local cloud providers and they're quite robust, and you could deploy it on there. Or I won't even go there, but you cannot do this. Like the banks may have an on-premise deployment of their core banking, which is 99.9% of the time the case. And this is why there's always one connector that sits at every institution and even at the central bank that allows them to access this shared layer and this national infrastructure. So the point I want to conclude with, and then we can open it up for a bit of a discussion and to see if there's any other questions. But it's important to realize that you want to create something, especially if you are in a market where you're about, and this is why this conversation, when Prasanth was asking me, what topic would you like to talk about? And I said, I want to talk about this because now we're starting to see that in the Middle East, in the region, banks and central banks and financial institutions are starting to say, okay, this is coming. Let's not kid ourselves. We are going to go into open finance. We're going to do this. The question is how to do it. And for countries that have, a very, let's say, cohesive infrastructure and ecosystem, and the right number of banks and financial institutions and other, ecosystem players, and have an existing consortium that is also governed by the central bank, this is probably one of the better ways to go. And in an instance where also some financial institutions want to leapfrog, and some countries want to leapfrog, they can start thinking about open finance right through the door. And I'll conclude with the thought that this, ladies and gentlemen, is what leads to open data, and this is what leads to open finance. Because what happens after you build this base infrastructure is the following. You start bringing in down here government entities. You bring in the likes of MOICT. You bring the likes of the government, all of the commercial registration or databases where you've got all the commercial licenses and the owners and the directors and such for KYB. You bring in and this is interesting. This is one of the things I admire about Australia. When they wrote the CDR, the Consumer Data Regulation, it actually started off with, open finance, and right off the bat, they started saying, you know what, we're bringing in open energy, we're bringing in open health, and you can start bringing in like there's a standard even for utility companies. Like, observation, this is a fact. In Iraq, I learned that there is no billing aggregator, and every aggregator or every company is just doing their own thing and they're connecting. Well, again, all the billers could be aggregated through this platform. The hospitals, the university, like the sky is the limit. And this is why the natural progression has always been open banking, open finance, open data, or the open economy. And the word open, by the way, guys, is not about openness. Yes, of course, it's openness and transparency, but the word open means standardized. That's the key definition of open in all of these contexts. It's standardization. So I'll take a pause here. It's a topic I'm very passionate about, and I can talk about it till tomorrow, but I think we only have limited time. So thank you so much for listening.
Hey, thanks, Abe. Thanks. We finally got a chance to hear you loud and clear fully. Yeah.
Good.
So, a couple of questions. So, one is, so I know you're interacting with the regulators on a day-to-day basis, and with that too, with 10 plus or 20 plus countries, right? So, specifically, we'll focus on the Middle East region. So, how open are regulators to such an idea of a
That's a
national
great
impact?
question. Great question. You know what? They are actually, like, they love it. They love it. They love the idea that their entire ecosystem will have a standardized way of connecting because they have struggled themselves. And interestingly enough, the banks are also quite interested in the approach because they're getting a lot of requests. Like, let me just give you a very simple one. In one of the countries, the regulator tells the banks, guys, our credit bureau is not being updated properly, etc. I expect that all of you are from now on going to provide these new data feeds from your core banking. Give me the customer, the accounts they have, the transactions, yada, 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 yada. And you're like, okay, you're going to, and they were about to implement this, everybody on their own, doing their own thing, XML, JSON, like just consuming a microservice. And when they heard about this, they're like, okay, we got to get this because that will save us so much work and effort when it comes to the integration and such. And the regulators, one of the things they like about this approach, and I'm talking even objectively, it's not about doing something that is unique, because we know in the Middle East we like to toot our horns and we're like, oh, we're the first to do this or we're the first to do that. But the reality is, when you talk to the people heading up these consortiums, or you talk to the central banks, they're like, we really want to help our infrastructure. We really feel that we are stuck. And this is just going to open up a lot of doors. So they think of this as a foundation, in order to bring new products and services and to open up new opportunities in the market. And they feel it levels the playing field. So in a nutshell, they actually have quite an open mind towards it.
Okay, great to hear that, because that's where from coming from a private organization and taking something like that to a regulator or a national bodies, this is that apprehension will always be there. And in general, we across the globe, I believe we all are pessimistic in that aspect, at least that that response is
Natural
going to
level of pessimism, yes.
yes. So the next one is on, one of the, I think one of the major driving forces for this open banking or an open finance need to be bringing this unbanked or underbanked into the banking sector, the formal banking structure, right? So how is that in terms of the journey in the open banking journey that different countries have taken or are intending to take? Where do you see that unbanked or underbanked or the bottom of pyramid, no matter what you call that, how do they fit in? I mean, are they in one of the driving forces, or it's just it's just an okay outcome? Okay, that's also happens.
No, it needs to be done upfront, on purpose, and by design. So the couple of examples that I gave earlier, or maybe on the other panel, is the fact that when you design your framework and you start implementing it, you have to be mindful of what products exist on the market right now and who's actually utilizing them. Some markets have current account and saving accounts, but the culture of the people, and this was fascinating to me, is that so they have an account, so they are banked, but the account has one transaction on it every month, pulling out the salary. That's all they do. And they take their cash and they stuff it under the mattress. And in other cases, you'll find that and that's like, let's say the 30% of the market. And then the 70% are just using digital wallets. And these, because for them, they just don't trust the banks. And I know this is weird because normally a financial institution is a place where you trust where your money sits. But when you've been in countries that have a lot of conflict and a lot of social economic imbalance, that becomes a situation. And then other markets where everything is calm and everything is transparent and life is good, but people who are usually the workers or the blue collar, they may not necessarily gain access to accounts. So what they end up doing, like smart companies started doing, is generating these e-wallets. So what needs to happen by design is upfront, you need to tell yourself, I'm going to launch with these set of APIs. They will be applicable to both accounts, bank accounts, and e-wallets, as an example. And then even when you start then doing payment initiation, you need to create that interoperability right up front, where right now, a lot of e-wallet companies will build it with that light level of interoperability, but it's not streamlined. It's not just as simple as a payment initiation. But if you are on one network using the same set of APIs, then that makes it a lot easier. Another thing about the underbank is you have a bank account, but you are typically not gaining access to financing. And this is a major issue, especially for small, medium enterprises, because sometimes they need that loan to be able to carry on with the business and such. And credit bureaus haven't done the best job when it comes to providing you a fresh view of the customer. And you only get to see, their credit cards and any previous loans. But if they haven't had a previous loan, how do you base it? And then the other aspect is the requirements. Oh, I need 3 years of audited financial bank statements, etc. But through this and by design, you build in logic that allows you to take the simple transactional data, look at how are you paying your bills? Are they being paid on time? Do you have money at the end of the month? Are you setting it aside? Like, do you have any excess liquidity? All of that stuff, and a simple health score can be provided, not to be a standalone, but to augment the credit bureau if there is a score there. And that, in a sense, will be helping the underbanked. So it has to be done by design from the beginning.
Right. Yes. Great. Thanks a lot, Abe. Thanks for joining us
My
on
pleasure.
both the days. Take your time out to share your insights.
Absolutely.
Looking forward to meeting you in person, hosting you in person next year at Apidays Dubai.
You can count on that. Thank you so much. Thank you for having me.